Hello class, and welcome to our today's lesson. This is actually the week 6, and I want to share a video on what I've just posted in this week. So in this week, we were doing the audit program for the cash and bank as actually the current assets. One thing you should be able to realize is that cash and bank are actually the most liquid items that an organization can have. And when we say it's the most liquid, it simply means that it is actually the easiest thing that can be converted into cash, and actually find that cash is already in cash form. And at the moment they are in liquid form, they can easily be embezzled. Remember that cash is very, very dangerous, and many people can be tempted to either steal or misappropriate it when good internal control measures are not put in place. The auditor should ensure that the audit procedures minimize the risk of this occurring undetected. Therefore, the audit objectives will be as follows as far as cash and bank balances are concerned. To establish that all bank balances and overdrafts are owned, exist, and have been included at the correct amount. What this statement means that if, for example, it is bank balance, it should be actually be in the bank. If we confirm from the bank that particular balance is being reflected in the business. If, for example, it is an overdraft whereby the bank, the business withdrew more than what it had, that should also be well captured, and that the amount should be the true figure that was actually borrowed as an overdraft. The other objective is to ensure that only genuine items are included in the reconciliation. When we were doing financial accounting, we talked about the bank reconciliation, whereby we reconcile the bank statement with the cash book. Therefore, only those items which are genuine should be included in the reconciliation. The third objective is to ensure that only genuine items are in the that is a repetition of the second point, and to ensure that cash sales are not overstated. By overstating here, if for example you have sold goods worth 15,000, then it should be captured as 15,000 and not more than that. And to ensure that no window dressing has taken place, meaning that some items might have been hidden somewhere and then they are now being captured as expenses being spent, which is not actually true. Ensure that is avoided. The procedure for doing this, the auditor should obtain a bank letter from the banks at which the accounts were open at any time during the year. If, for example, I'm an auditor and the bank or the business operates an equity account, then I can seek from the equity bank whether the bank balance that is being captured in the book is actually the correct balance that is in the bank. This procedure should be followed by even if the client has changed their bank during the year and closed all the accounts. So you should find a way as an auditor of tracking whether the figures that are recorded are correct. Bank letters should be checked against other audit evidence to ensure that they are consistent. Like, for example, if you can get a balance for a particular date and from that particular date some payments have been made, you can confirm that from the receipts that were issued or given at that particular time, so that you can be able to confirm the changes that have taken place. Data should be sent to the banks at least 2 weeks in advance to the date of confirmation, so that we don't ambush maybe the bank. The auditor should obtain the proper bank reconciliation from all accounts and complete the following audit tests. The bank balances should be checked to the bank statement and bank letter. The cash book balance should be checked to the nominal ledger, and cleared items should be checked two after date bank statements noting the dates items cleared and such kind of thing. You'll find that all these procedures are meant to ensure that the cash balance that is actually being reflected in the book for accounts is actually what is correct. When we talk about cash account, where the client has material cash balances, the auditor should carry out the cash account. If, for example, if the business has got substantial liquid cash in the cash box, then a lot of audit needs to be done as far as that particular cash account is concerned. The following procedure should be undertaken. Cash should be counted in the presence of the members of the current staff who is responsible for cash, and all cash balances should be counted at the same time. Include and maybe, for example, have that particular person who maintains that particular cash box to be present when that money is being counted, and then as you confirm how they were received and how has been spent, the member of staff should be asked to sign to confirm the amount counted, so that maybe the auditor should not be given or should not shoulder blame whereby maybe some money is lost and then you are told you are the one who took it. The cash balance should be agreed to the nominal ledger. Explanation should be obtained for any material differences. Cash account should be undertaken at the year end at the same time when the stock take is being undertaken, because it is at that particular point whereby now you reconcile the amount of money that was spent in buying stock. Because you have counted stock, you should also count the amount of cash. The internal control here involves the duties of the person writing up the cash book should be separated from the person responsible for making payments. That is actually to safeguard the cash. If, for example, I'm the person who issues or maintains the cash book, and then I'm the person who handles the payments, then there's very high chances that I can manipulate the figures. I can make a payment of 2,000 and then record there it was 20,000, and the difference maybe is embezzled. Opening of a new bank account should only be possible with the authorization of the board of directors. Employees or the middle or junior employees should not have permission to open accounts anyhowly, because this will create a loophole whereby a person can actually divert money. Instead of being deposited in the bank account of the business, they are deposited in individual accounts. There should be adequate security of a blank checks to avoid a case whereby a person can sign the check and maybe deposit that amount of money in his or her account. Cash book balances should be regularly reconciled to the nominal ledger to confirm the items which are actually missing in those particular cash books. Checks should be dispatched immediately after signature and not returned to the person who prepared them, because that actually again can create another loophole. A senior member of staff should be independently check bank reconciliation and reconcile that one with the cash book. Cash account should be undertaken on a regular basis, and petty cash voucher should be authorized by a senior person. That is, how will you confirm whether some cash has been embezzled? What we call here window dressing. The auditor should review material receipts and payments in the final month of the year and for a reasonable period after the year end to assess whether they appear unusual. Investigate delays in banking receipts. The auditor should investigate delays in presentation of checks, and this may indicate that checks are not being held back. And then, after noting that, it is going to be worth noting of common methods of window dressing, including cash received after the balance sheet date, that is after the year end, using bank borrowing facilities immediately before year end to replace cash or deposit, thereby improving liquidity, or transferring cash to other group of companies. Sending checks to creditor before the balance sheet date, but not entering them in the cash book until the following month. All these are meant to address the risks that are actually going to be faced in handling cash. I want maybe briefly to talk about the audit of non-current assets. Non-current assets are actually the fixed assets, which are actually tangible. Tangible meaning that they can be seen. So here, the majority of testing being undertaken would be for overstatement. Overstatement here is a case whereby the asset has been overstated. Instead of the value being the correct, that value has been exaggerated upwards. And we find now it is the work of the auditor to confirm whether the value that has been entered in the books of accounts is actually the correct value. There is a concern that the value of the assets incorporated within the balance sheet will be overstated. The specific objectives that should be addressed when auditing fixed assets are as follows. Number one is to ensure that the assets exist at the balance sheet date. Here is to confirm that if we have said that the furnitures are worth this much, at the balance sheet date, which is actually the end of year, the date for the end of that particular financial year, you confirm whether those assets actually exist as captured. Ensure that the assets are owned by the client. You can find a case whereby the assets are, yes, indicated, but they are not owned by that particular company which you are auditing. Ensure that assets are completely and accurately recorded at cost. Remember here, there's that principle of cost whereby an asset or a fixed asset should be captured at cost, and thereby the subsequent years we should be deducting the depreciation for that particular asset. Ensure that all revalued assets are supported by proper valuation and that the basis is acceptable. The valuation, especially when we talk about the land and buildings, they have a tendency of appreciating. So if you do the revaluation, that particular revaluation should have been supported by the proper records and actually were authorized to ensure that disposals are accounted for correctly. If an asset was disposed somewhere in between the year, then that particular disposal should also be authorized and should be accounted correctly. Ensure that the depreciation is correctly calculated and that the rates applied are adequate to write up the costs of the assets less estimated residual value. Lastly, is to ensure that there is adequate consideration of impairment, which are actually the assets which are not in use. All those procedures. Now, how would you confirm that? The auditor should determine the most appropriate procedure for the particular circumstances. Remember, not all circumstances are appropriate in conducting the audit. Some environment might be favorable for a particular company, but may be unfavorable for other companies. So choose the appropriate procedure for a particular circumstance. The auditor should select a sample of fixed assets from the fixed assets register or any record of assets maintained, including additions during the year. Remember, if a company is big enough and it has quite a number of fixed assets, there is what we call the fixed asset register, which contains the name of the assets, their registration numbers, and such kind of information. You can go directly to that register and maybe do a sample of 10 randomly, and then you do some audit on them, confirm whether they are there, whether the cost that they have been indicated is actually correct, whether the depreciation charge is correct, and so on. And the moment you find that the sampled register assets in that particular register are correct, then you can conclude maybe that organization is coming up with the proper records of accounts for that particular financial year. Here now, remember, again, I want to say that the audit program is actually meant to confirm whether the records and actually the items in the accounting records are actually recorded in the correct way and with the correct figures. And at the end of the day, you will find that now the books of accounts, because they contain the correct items with the correct values, then at the end of the day, those books of accounts are said to be recorded in a proper way. So as you read about the procedures and the risks, make sure that you grasp those important points, which will make you understand actually how auditing does. Remember, you are accountancy students. At the end of the day, this will be one of your roles. If you are employed as an auditor, this is what you are going to do. So you need also to understand how we go about it. I want to stop there for this particular video as I wish you lovely moments. Thank you.